The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar entitled Death to Restricted Property Trusts. The webinar will last approximately 15 to 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
Thanks very much, Jennifer, and welcome everyone. I'm glad you're with us today to talk about death to restricted property trusts. It's an interesting case, the Mann Construction case, which takes aim at one of the ideas that is kicking around in our business that has been positioned to provide a strong employee benefit for the owner of a company. But before we get too deeply into that, let's decide what we're going to talk about next month. We have these free webinars on the first Wednesday of every month. Next month will be on May 5th. And we need your help in deciding on which one of the three topics listed we're going to talk about. Your choices are HSAs in a nutshell, reconciling coronavirus-related distributions on the income tax return, and captive insurance loses again. Let's go ahead and open the poll, give you the chance to pick your choice for next month's webinar. The poll is now open. Please go ahead and take a second to vote. We'll give you about 30 seconds for that. Just another second in case you still want to vote. All right, we're ready to close the poll, and next month's topic will be captive insurance loses again. Thanks for voting, and thanks for picking next month's topic. All right, so let's go ahead and talk about this Mann Construction case and restricted property trusts. You know, ever since I've been in the advanced sales, in and around the advanced sales business, and I started, it's hard for me to believe, back in 1987, from my perspective, the holy grail of life insurance has always kind of been finding something that a business can provide, permanent life insurance related, that a business can provide that generates an income tax deduction for the business without forcing the insured to include the premium in taxable income. And I say this is the Holy Grail because it really, provides everything that is desirable on the premium side, and it's something that the owner of the company would really implement for the owner's own self if it was available. And I've been in the business, as I said, long enough to see various ideas come and go. In the past, I've seen ideas such as charitable reversible $1, which was popular in the late 80s, early 90s, which we thought would achieve these goals. I've also seen Section 419 plans in various flavors come and go. We'll talk next month about captive insurance plans, which is another way that we're seeking to pay for permanent life insurance with pre-tax business money without having to include that money in the owner's income. And again, in my experience, the service comes in to crush those dreams of the holy grail of life insurance in one way, shape, or form generally. And it seems like that's the story with regard to restricted property trusts. Well, what is a restricted property trust? What is that idea? They have some flavors, but as near as we can tell, the idea of a restricted property trust is for a business to provide needed permanent life insurance for an employee of the company where the premium contribution on the business's part is deductible right away, and the employee doesn't have to recognize all of the amount contributed as taxable income in the current year. And it's whole life insurance centric. Ultimately, the employee ends up owning the policy personally and enjoys all of the tax advantages associated with permanent life insurance without having had to recognize the entire income tax result associated with the business paying the premium at the front end. And in the Mann Construction case, the IRS decided that the restricted property trust arrangement in it was a tax shelter, and it was not going to permit the plan to go forward. So here's a little bit more detail about how a restricted property trust might work. So the business and the employee enter into the restricted property trust agreement, and that names the business the trustee of the trust. And the trust is for the benefit of the participating employee and a qualified charity. One of the key characteristics here is that the business is not a beneficiary of the trust. So the business doesn't get back its money or the life insurance policy, and that's important for the idea that the business's premium contributions would be tax deductible. And so the business, at least theoretically, makes fully tax deductible contributions to the restricted property trust for a select group of participants. And usually that's the ownership group if this works the way that the restricted property trust is intended. Of the amount contributed, a portion is considered current taxable income to the participant. And the taxable amount is apparently based on the economic benefit value of the death benefit, the Table 2001 amount, plus an amount that is treated as an immediate bonus. And based on a lot of the support materials, the advocates for the plan that I've seen, that's usually about 30% of the amount contributed. And how do we do that? How is the business able to get a tax deduction for the whole premium while the employee doesn't have to recognize all of what's being paid by the business in income? Well, it's because we've got this intermediary trust in the picture. The trust is the one that actually holds the life insurance policy. The participant has the trust name a personal beneficiary for the death benefit while the restricted property trust is in effect. And in general, the restricted property trust lasts for 5 years with the possibility that if all the parties agree, additional 5-year funding periods can be agreed to as well. And if the business fails to fund the restricted property trust as is required under the trust agreement, the assets in the trust don't go to the employee, they default to a qualified charitable beneficiary. And so that's kind of the construct that's needed in order to make this thing hang together. And if the business funds the restricted property trust until the end of the agreement and the trust is not renewed, the trust's asset, the whole life policy, becomes the sole property of the employee participant. At that time, the participant pays income tax on the cash value of the life policy less the amounts the participant had previously included in taxable income. Well, in order to kind of make this thing work so that there's not a big tax result at the end of the 5 years, there's a Section 83 election that is made by the participant at the beginning as the premium deposits are made. And so the participant decides to include roughly 30% of the employer's contribution in income through a Section 83 tax election, even though the employee might not get the money at the end if the employer fails to make the premium payments, right? So the money would go to charity, the money in the trust, the policy would go to charity if the employer fails to fund the policy for the agreed 5 years. And so that's a risk of forfeiture that's built in there. So instead of that, the employee includes in income that 30% of the premium contribution along the way under using and makes a Section 83 election, even though the employee might get nothing because of the risk of forfeiture, the employee decides to include that amount in income. And so at the end of the 5 years, when the policy is apparently not worth much more than what the employee has included in income during that 5-year period, then the employee ends up getting the policy without much more of an income tax result. And the whole Section 83 election part is designed to avoid the requirements of 409A. The employee includes the amount in income at the beginning so that it's not deferred comp. The employee includes the value of the plan in income at the beginning to make it look like it's not deferred comp and thus not subject to the requirements of 409A. So, if it feels like an artificial design, it's only because it is. It's designed to achieve certain tax results, by dancing through the various portions of the code. And that's not to say that, there's anything necessarily wrong with a restricted property trust, but because of its kind of strange design, which seems driven to achieve certain tax results, it made it ripe for IRS attack, and that was what happened in the case of Mann Construction versus the IRS. And so here are the facts in Mann Constructions. Here we've got an S corporation owned by 2 people. In 2013, the company decides to implement a restricted property trust plan on both owner employees. And the details of that particular restricted property trust implementation were similar to those that we just talked about. And the trustee of the restricted property trust was an independent trust company. And so they bought whole life policies on the lives of the 2 owners of the company and all money contributed to and the assets owned by the restricted property trust were subject to a risk of forfeiture, in that the employee didn't own what was in the trust until that risk lapsed over the 5-year period, the typical 5-year design. And apparently the participants made proper Section 83B elections in 2013, recognizing the cash value of the policy as taxable income, despite the fact that there was a risk of forfeiture. They decided to include it in income early, and that's allowed apparently under Code Section 83B. Now the IRS didn't like that, and the IRS said, look, we came out with a notice in 2007, Notice 2007-83, which applied to Section 419 plans. And we said that if you implement something where you've got permanent insurance owned by a trust, and you get a business tax deduction on the front end, and you don't include that premium paid by the business in the front end and the employee's income, we're going to call that kind of thing a listed transaction. And that makes it a tax shelter. And so taxpayers, you've got to let us know when you implemented a tax shelter. In the Mann construction case, they didn't think that their configuration was subject to IRS Notice 2007-83. And the IRS disagreed, and so it imposed substantial penalties for their failure to comply with the requirements of 2007-83, failing to tell the IRS that they were involved in a tax shelter. So the IRS imposed those penalties, the parties paid, and then they filed suit in Michigan seeking to have the penalty refunded. And ultimately, the court decided that the service was correct, that the 2007 notice did apply, that Mann Construction's petition for the refund of the amounts that it had paid earlier was going to be denied, and therefore this was not, this restricted property trust did not produce the tax results that the folks intended. And so, what are the conclusions that we can take away from the Mann Construction case? From our perspective, what that means is the IRS is continuing to effectively shut down tax aggressive permanent life insurance strategies. They've identified most such plans as listed transactions, particularly those that seek the holy grail of life insurance planning. It seems like restricted property trusts have joined the club of plans that are being shut down. Now, I gotta caution everybody about that. It's possible that somebody will have a restricted property trust configuration that will ultimately satisfy the service. In fact, some who promote restricted property trusts may claim, even after this case, that their configurations are the latest and greatest and will still work. But I think those of us who want to avoid making our clients famous, who are conservative on our clients' behalf, will certainly want to take notice of the Mann case and think twice, 3 times, 4 times before putting our clients in a situation where they're going to rely on the logic behind restricted property trusts, and perhaps recommend to our clients, if our clients don't want to run the risk of being famous, that they might consider doing something else. I think that's a reasonable conclusion to draw in light of what's happened in the Mann case. Certainly, restricted property trusts need to be thought about because the chances that the IRS are going to look at them, audit them, perhaps litigate them, is something that means that there's an added cost to that kind of implementation. I think what that means for those of us who are conservative, that we're going to go to stuff that's tried and true, bonus plans, even, split dollar or some form of traditional deferred comp is going to work better for a lot of our clients than, this kind of an idea. And the high price needs to be thought about when seeking the tax holy grail of life insurance. And certainly the folks at Mann Construction seem to have paid that high price. And that's a lesson I think that all of us can learn. I'd like to thank you for joining us today. And at this point, I will turn the program back over to Jennifer to wrap this up. Jennifer?
Thanks, Lennis. And thanks for joining us today. And don't forget to join us on May 5th for Captive Insurance Loses Again. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. We'll be posting today's webinar on our YouTube channel, where you can check out all of our past webinars as well. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.